everyone, my name is Paul Cooper and I'm the manager of Totes and Notes, and this is going to be part 2 of the Profits and Loss series that I started last week. And so each week we're going to go over a financial profit and some of the market risks and other investment risks that you may be facing and how you could experience losses. So without further ado, let's go ahead and get into it. Just a quick disclaimer, I'm just going to let this be up here for a couple seconds and you guys can read it and pause it on your own. Basically, I am not a certified professional, attorney, financial, or otherwise, so make sure you always get the appropriate professional when you need to get any type of counsel. Here's some serious topics and key points. Again, this was in the first video, so I'm just going to leave it up for a few seconds so you can go back and look. We're just going to be talking about buy and hold and other long-term strategies that are passive, how they can really come back to bite you, what you can do to deal with it, and some other investor psychology and factors. So our second prophet is going to be Dave Ramsey, and I call him the Debt Crusader, and that's probably a term that he would use for himself. He's spent the last, almost probably 30 years, maybe more, I think it's 25 years, helping people get their finances in order, get their debt in order. He's, broadcast across the nation, I think even to ships at sea and even around the world on his show. So his initial story is he made and lost a fortune in real estate. I think he was 25 or 26, and then basically 2 years later was broke. He was able to get some lines of credit and some loans early on from some family friends, I believe, and that worked at banks, and that's how he got into real estate. So I think he said he had $1 million. He made $250,000 that year, and had $4 million worth of real estate, and I think they were mainly residential homes that he was renting out. 2 years later, I guess he had some bad luck. He was fairly leveraged, and so some of the loans came due. I believe one of them he wasn't late on, but it was sold somewhere else, and for whatever reason, they accelerated it, and he had roughly 90 days to pay it off. He had some other notes with other banks that came due, and so he basically had to declare bankruptcy to protect himself, and he talks about that and how that kind of shaped him. Very strong work ethic from a young age, and then this really bit him hard, and that kind of started his life of no more debt, I hate debt, and that kind of extremist viewpoint. And so he was able to dig himself out of that hole. He talks about it. He and his wife had to sacrifice for a few years there, and then they worked their way out. He eventually started helping other people and creating some classes and organizations that did financial education, and then eventually parlayed that into a show with another individual. I can't remember his name, and then he eventually got his own show. Dave Ramsey's kind of got these simplified financial rules, whatever you want to call them, but he calls them the baby steps, and they lead you in a sequential order on how to get out of debt and start saving for retirement. Step one, I believe, is saving $1,000 for emergency fund, and then eventually you start paying off debt, then you start saving towards retirement, then you pay off your house, and then you just invest and give like crazy. Very logical order for the most part. He also believes in he calls it the debt snowball, which means you pay off the smallest debt first, and then the next smallest, and so on, that you work your way up, and then it kind of snowballs out of control. Very similar to some other people, a little bit different. I believe Susie Orman takes the other approach where she likes to pay off the highest interest debt first and then the lowest interest debt. That's probably more mathematically logical, but at the end of the day, you do what works for you, and Dave likes that approach and teaches that approach because a lot of people, when they're really hurting, they need an initial victory. So even if it's only a $300 debt, you pay that off, boom, okay, you don't have to pay that bill anymore. That's got to be a pretty decent sense of relief. And so it's going to depend on the individual, but that's the way he teaches. And so really, if you're throwing extra money at your debt and paying it off quickly, then that's what's going to get you out of the hole. And then his investing philosophy and strategy is he's really into investing in mutual funds, and he really hits that hard aggressive growth in income, and some international. And then he also he likes investing in real estate, but he does no debt real estate and mainly residential homes. And so he basically wants you to have cash for any residential or any type of real estate investment that you get into, no leverage at all. He doesn't want you to use debt. Preaches never ever use a credit card no matter what. And so it's a pretty extreme viewpoint. The one thing I do like about Dave is, even though I'm not religious and he kind of comes from a religious background, he doesn't force that on anyone, but he does kind of use a biblical approach. And Proverbs is nice because this one quote: "The rich rule over the poor, and the borrower is slave to the lender." Yeah, so and you'll hear that a lot. I believe AA will also use it, where anything you can't say no to is your master. So it's a pretty good point to nail home that when you owe, you're not exactly free. This is kind of who Dave Ramsey is in a nutshell, in a quick view. And so now I'm going to kind of tell you what I disagree with. And the main thing is the whole mutual fund. We beat it pretty good last time about how stocks and mutual funds and the buy and hold philosophy can really be devastating to your portfolio over the long run, because unfortunately the long run for us isn't that long. And if you get in one of those bad recessionary periods where you lose 14 plus years, you could really be hurting it and not get ahead. I'm not into the extremist viewpoint of never having debt, never ever using credit cards. His excuse is well, they're like a rattlesnake. They'll come back and bite you. Rich people never got rich off of their credit cards and points and stuff. And that's true. But at the same time, if you're responsible and you pay them off each month and you can get points for a vacation or cash back, why wouldn't you? That and the security of using a credit card and getting some of the perks, like getting an extra 6 months to a year on manufacturer warranties, is nice. Then the thing that really kind of pisses me off about Dave Ramsey is he's always saying invest in mutual funds, growth, aggressive growth and everything. It's like, find yourself a mutual fund that has a long track record of beating the stock market. It's not hard, they're out there. And people ask him, okay, well, which one's? Like, oh, you just got to do some research. It's not that hard. You can look them up. People say I that this isn't true all the time and that I'm wrong, and they're just insane. I hate that look it up phrase. I mean, people do need to do some research on their own, but, look it up or Google it. The reason he's saying that is because he can't provide it. If he could provide it, then he would just list off a couple of them. I mean, he gets paid a ton of money for his for the people he recommends. He calls them his ELPs, the is it enhanced or educated local providers, whatever, for whether it's insurance, stock investing, financials, whatever. He calls them your ELPs, and they're on his referral list. Well, they pay to be on there. I'm sure they're probably good, but they're paying to be on there. And then the other big thing is a few years ago when they were trying to make financial advisors legally be fiduciaries. And what that means is when you have a fiduciary, they are legally beholden to have your best interest at heart and to act that way. So if someone's not a legal fiduciary or not a fiduciary, they legally don't have to have your best interest at heart. They could be advising you and making decisions on your behalf that are better for them than they are for you. So why would you want that in a financial advisor? And he said it was going to kill the industry and everything. The reason he's saying that is because he's getting paid off. I mean, there's no other logical reason for you not to want your financial advisor to be a fiduciary. It's going to kill the industry. Well, if they're doing well on your behalf and making your money, then they're going to get it through fees and everything else. So it doesn't make sense. I think Dave Ramsey, for the most part, is a good person. I think his debt snowball and his baby steps are helping a lot of people. And a lot of those people aren't very savvy when it comes to finances because, they'll tell you that they have like $200,000 worth in debt, and you'll hear how they got it, and you're like, wow, I'm surprised you can even count to $200,000. So those people, when they've been messing up that long and they don't understand, they need exact rules. Someone with a little bit more education and everything, you could probably get away with some other stuff and do some different things. I wouldn't hold that against him, though, because, again, he's generally dealing with people that have been messing up for a long time. It'd be like someone who comes in that's extremely overweight and you're a personal trainer and dietitian. It's like, look, no, you can't even have sugar-free gum. You've been messing up for so long. This is the diet you have. You do not deviate from this at all. And so I get it, and I like him for that. But the never using credit cards and his just constantly get mutual funds without actually giving, a mutual fund example that's consistently beat the market for 10 plus years. That really bothers me. And just the whole dismissive, oh yeah, I'm right. And, look it up because they're out there. If it's easy, you should be able to give an example. But I think I'm going to quit harping on Dave Ramsey again. I still think he's a good person. I think he's done a lot more good than what my snarky remarks might lead you to believe. I think he's helped a lot of people. There's people every week calling in, doing debt-free screams, getting their life on track. And so that's a really good thing. I think he's overall, he's definitely, I think, improved the world around us. So let's do a quick recap from last week, and the main takeaways from last week were dividends and dollar cost averaging only shorten the time needed to break even. They don't eliminate it and they don't prevent it. Most investors don't invest that way as much as Wall Street and other financial advisors like to tell you that dollar cost averaging is utilized, because it is a decent strategy. It really isn't that much, and the few people that do use it usually are in it's in their retirement accounts, and it's $50, $100, $200 a pay period or month when they contribute it to it. Most people aren't using dollar cost averaging. And then the other big thing is most adults only have 1 or 2 market cycles before they retire, not 90 plus years. If most of us had 90 plus years to invest, then yes, we could probably average anywhere from 10 to 12% over the long term, even with the drawdowns. But we don't. So part 2 is titled Life Saving Your Life Savings. Nice little tongue twister. And so this section is going to talk about savings and investing and some of the issues that we have with them. So what's wrong with savings? Well, some of those biggest issues that we have with savings are inflation and then market corrections. We went over that a lot last week. And then the savings rate. Most people don't account for inflation. If they do, they're using a very low number as opposed to what's probably true. Again, that number's tweaked each time by whoever's in office because they want inflation to look how they want it to look. So if inflation's really rampant, then they'll remove stuff to make it look lower. And if their person's not in office, the other party, then they'll add stuff to make it look higher. You'll see some funny charts every now and then if you Google like the Big Mac chart, and that'll show you the inflation for a Big Mac around the world, how much money it costs in whatever denomination that you use to buy a Big Mac in that country. So that's kind of interesting. I think you can do the same thing for Snickers bars and other general little snack items and things like that. The savings rate is really low, especially in Western countries. U.S. is terrible. My generation, the millennials, really bad. Part of it's just, I think people have given up on savings, and then the other part is a lot of people still have really bad jobs and high debt, so there's no point saving because they'd be better off using that money to pay down debt. And so last week we talked about Real Investment Advice, the website that I borrowed some charts from. Really good stuff. They wrote a series of articles. We're going to go to the second article, and I've got this website down here. If you don't get it, you can always pause it and go back. But let's go check that out, and we'll talk about a few things there, and we'll talk about this chart. And I will do my best to remember to link this article in the description. But what we're kind of taking away here is this chart is being used to set up an example. The example is Bob, a 35-year-old. He earns roughly $75,000 a year and wants to save 10% of his gross salary each year, so he can have roughly the same income in retirement that he currently has today. So he wants to have inflation-adjusted $75,000 a year when he's in retirement. And so we're going to assume the market returns 7% each year, and which is what a lot of financial advisors will say, kind of this, oh yeah, you should easily be able to safely make 7%. And then we're going to assume the inflation rate's 2.1. That's how we're setting up this graph here. And so we're doing 30 years. So Bob's 35 to start with, and we're 65 at the end of this. And so look at what his annual income has to become to be the same amount that it is now. So to adjust for inflation, year 1, 75,000, year 30, it's 137,000 roughly, just a little over. 30 years from now, he needs to make 137,000 just to basically have the equivalent of what he's making now. So that's a pretty big relevation. That's almost doubling what he's making now in 30 years just to be right where he's at. And, it talks about it right here. It's kind of scary. And then that 2.1% inflation is very, very modest. It says so right here. 2.1. A lot of years it's 3 to 4. Stealth inflation can be even higher. And that what stealth inflation will be a lot of things. It'll be one, articles that are removed from the formula. So because those are becoming expensive, they want to make inflation look lower. And then 2, you'll see this a lot at like dollar stores and Walmart and things like that. Stealth inflation's when, the Snickers bar still costs 99 cents, but it used to be 4 ounces and now it's 3 1/4. And so they'll have less per package of the item you're used to buying. And so you're not getting the sticker shock of the price going up, but you're actually getting less. It's the same thing, and so you'll see that as stealth inflation. And then further down here, it's the assets required to generate that $75,000 income equivalent. Again, so it's going to be like $135,000 a year in 30 years, but it's the $75,000 equivalent at a 3% withdrawal rate. So if we look at that on average, you can see this number here. Let me pull it up. A little over $4.5 million. That's what he needs to have saved in 30 years so he can basically have his $75,000 a year retirement. Granted, it would be 130 some odd thousand that first year just to give you the equivalent. But so he could live the lifestyle that he's living now, and 75,000 he could have in retirement and through retirement. So the $4.5 million. And then let's look at this a little bit further. The analysis, it gave Bob a huge advantage. It talks about how he's a diligent saver. He started with 100,000 saved up, and then right here, it's the period in 1988 following the 87 crash. So we're giving him some of the best years that the economy ever saw in the equities markets. Had that huge crash, boom, roughly 12 years of just awesomeness coming to Bob for his retirements. It's also talking about how he contributes $625 a month for dollar cost averaging. Again, most people don't do that. So that's how they set it up. A pretty rosy picture for him to get to that $4.5 million. And so this chart down here is got a pretty good takeaway. So this gold line is the $100,000 that he had to invest plus his $625 a month. And this is a buy and hold strategy. So each month he just buys into the market. And this is simulating a total index for the market. So it's not certain stocks, it's the whole market. So 1988, because remember we're setting up after the 87 crash to give him the best years possible. So this is what it does the whole time, buy and hold. So we're pretty good until about 2000. Remember what happened in 2000? The big tech stock bubble popped, and so a little bit of a dip here, and then it takes a while where he just kind of flatlining and gets up to here. And so after 30 years, he's at 1.8 million. That's, respectable, but that's not what he needed. Remember, he needed the 4.5 to have the equivalent with the drawdown rate and everything. So this blue line here, exact same setup, except he's done something to help him with the downsides. So whenever the market drops below, I believe, the 120-day moving average for the market, so that indicates that the market's going down, then he sells everything and goes to cash. And then he buys back in once the market's stable. And so you'll hear, if you do a little bit of research, you'll hear a lot of strategies like this. Very basic, not super technical. And it's more of an active strategy, but it's not super active. You're not having to sit at your computer all day, every day and do it. Follow this up. Same time period, same amount of money invested, but just following that one little strategy to help defend his retirement account, he's able to get to almost, $5.75 million. Pretty significant difference for the same amount of money, the same time period. This just further illustrates that buy and hold is not the way to go. It doesn't give you the protection you need. Don't get me wrong, timing the market's very hard, and most people will tell you it's very hard, but there are some strategies you can do, like following the 120-day average to figure out the general heartbeat of the market and see if it's healthy or not. And so it just further illustrates, the article says here, there's an important point to be made here. The old axioms of timing the market and the power of compounding are true, but we talked about this last week. The destruction of principle, aka losing money, just destroys both the time and the magic of compounding. It just does. If you're losing money, you've lost all that time, because remember, in a lot of those examples, it was over a decade just to get back to even. Spending all that time getting back to even and not growing just kills your returns in the long run. And my apologies here, folks. I want to do a little bit of clarifying. The blue line utilizes a simple switching strategy that goes to cash whenever the S&P 500 declines below the 12-month moving average, not the 120-day, which makes more sense because 120 days could be influenced by a lot of things. You have a big uptick or downtick in the tech stocks, and that could influence. But 12 months is going to be a little bit more stable. So again, the blue line just simulated simple switching strategy that goes to cash whenever the S&P declines below the 12-month moving average. So if you're interested in keeping some equities for your retirement to be a little bit more diversified, you may look into using a strategy like that. Talk to your advisors, see what they say. But a lot of the active advisors you're going to pay more money to, and they're really not going to, they may not have a very good strategy, whereas this is something that you could actually implement yourself and have it be pretty much fully automated. with some trailing stop losses and things like that. I know that sounds really complicated and you would need to spend some time with your brokerage platform, but there are a lot of electronic platforms that allow you to set that up for no extra cost, just your general $7.95, $4.95, whatever the trading fee is, and you could set that up and kind of protect yourself. And then the final part of this article that we're going to talk about is the other big problem for dollar cost averaging that I was hinting at. Most people aren't doing it. A lot of people aren't saving for retirement. If they do, it's going to be in larger lump sums. This chart right here talking about the real disposable income, the gap between what people are making and what they need is pretty large. Most people have debt, so they're just not investing due to that. And that explains kind of, too, what the problem with savings is it's hard to save when you don't have the money to save. Or what are you going to do? You're going to save money but just build up debt? Then you're maybe going to spin your wheels if you're lucky. If not, dig yourself into a pretty big hole. And so that's why there's a lot of people that aren't saving for money or saving for retirement. I believe it's like a $400 or $500 emergency fund. Most people couldn't pay that out of pocket. They would have to carry some type of credit card balance or some other debt or do payday loans for $400 to $500. That's pretty crazy considering that's a lot. That for most people that's just a car payment. So very scary stuff. I don't know what your situation is, but if you're not able to save money right now, you probably should look at a strategy getting out of debt. And honestly, as much as I bashed Dave Ramsey for some of his stuff early on, you may want to look into something like his strategy and just to get on the right track and get started. So the last section here, avoiding traps. Again, just reiterating, don't lose money. If you're losing money, then you're really going to be hurting. You're shooting yourself in the foot, whatever analogy you'd like to use. So how do you avoid traps? Well, you could just not participate, and you can't lose what you don't put in, but at the same time you can't win either. So and honestly, if you don't participate in some type of investing or savings, well, I guess you could save, but if you don't invest, you're not earning something on your money that you're saving, then you're kind of still losing due to inflation. The other thing you could do is, hire the best financial professionals, kind of. But we've also talked about how a lot of them are really bad. How do you tell the good ones from the bad ones? A lot of them are really inexperienced, so you probably need to try to look someone with a track record. But a lot of those people are retiring. It's a lot. I think the average age for the financial industry right now is probably late 20s, early 30s. So there's a lot of young people in there that don't have the experience that you may be looking for. So you got to be really careful with that. Again, we're mainly talking about equities. There's a lot of other things you can invest in. Stocks, bonds, treasuries, there's, insurance, real estate, all types of real estate. There's businesses, there's a lot of stuff you can invest in. But a lot of that too won't make sense until you've saved up quite a bit of money. And so where do you put that when you're just starting off? And most people, that's going to be stocks or bonds. And so just be careful. Find some good advisors, get some good counsel. And then the last thing that you can kind of do is implement some checklists. And these could be used for a lot of things. It could be, hey, my advisor needs to know these type of situations. These investments need to meet these type of situations. They need to have this type of security. It needs to have this potential upside. And then you could even apply this to your own investments, like we were talking about with the 12-month moving average. You could implement something like that, where it's, okay, when do I get out of the market? When do I sell? When do I buy? These are the signals. These are the points that indicate that I do this action. It could be a basic flow chart or something. But yeah, if you're just jumping in willy-nilly and you don't really have a plan and you don't have someone else looking at it for you, you're probably going to hurt, unfortunately. That's it for this week. I don't know if I'll have the third one out next week since it's going to be kind of 4th of July week/weekend. I may hold off just because so many people are going to be out of town and spending time with their loved ones and family. So may not have it next week, but if not next week, the week after. If you have any questions or comments, don't hesitate to reach out. Good, bad, otherwise, I'm more than happy to address it. And I appreciate your time, and you all have a good weekend. Thank you.